All right, John Cox here with Nexa Lending. Um, I want to discuss with you today some things about reverse mortgages, the home equity conversion mortgage. And many people don't quite understand what that is all about. And I have a quick presentation as soon as I get it up and running here. Center view. Yeah. Why is it doing that? There we go. Okay. Apologize for that. Now, okay. Well, screen two. There we go. Okay. So, all right. Separating fact from fiction. Put your mortgage in reverse and your life in gear. Separating fact from fiction, a financial resource which it's needed when it's needed most. This is presented by myself at Nexa Lending, our Hecm. What the Hecm? Home Equity Conversion Mortgage, HECM, Hecm program. All right, let's talk about what is a reverse mortgage. First of all, it's a government insured loan, the home equity conversion mortgage that allows senior homeowners to convert a portion of their home equity into tax-free cash. So, not taxable, without giving up ownership. You keep the title, you never forfeit ownership, you decide when or if the home is ever sold. No monthly payments, the loan is repaid in one payment when the last homeowner leaves or passes, and 100% remaining equity. After loan repayment, all remaining equity belongs to you, your heirs, or your estate. So the beauty of this is you don't lose any ownership. You get to utilize the equity that you have in your house. And there's a number of ways you can do that. We're going to cover that shortly. And at the end of this, it totally belongs to you, your heirs, and your estate. Who qualifies? Do you qualify? If that's the question, qualifications differ significantly from traditional mortgages. Many who won't qualify for a conventional loan can qualify for a reverse mortgage. First criteria is for the fully backed government Hecm program, which is the FHA Hecm that was um, started in 1987. I think was when the laws were passed. I believe it was 87 or 89, one of those right in there, the Reagan era, that the home equity conversion mortgage was put into place to assist um, people in retirement. Basically, the 62 plus age is what was set as the lowest age of the young or the youngest. It goes by the youngest borrower. So if you have two people in the home, the part of the criteria is that um, one of you has to qualify and be 62 plus. And then the other thing is they base all the loan criteria and guidelines in terms of the loan amount, what they'll do, rates, all those things are based on the youngest of the two borrowers or if two borrowers are involved. Two, it must be a primary residency. So the home must be your primary residence. Can't be a vacation home, can't be an investment property. So it has to be where you're living and where you plan to reside. Number three, is it an FHA eligible property? So home type and condition must meet standard FHA guidelines. That means condos are also available for this program as long as they're FHA approved condos. So that is a plus there. And number four, final assessment, demonstrate willingness and capacity to pay your taxes, insurance, and your homeowner association dues. So one of the only criteria of this program is that you live in the house. You annually certify that you are the primary, that is your primary residency. Number two, you have to pay your annual property tax, your insurance. That's hazard insurance, not mortgage insurance. So hazard insurance on the property so that if anything does happen catastrophic, it can be rebuilt. And then your homeowner association dues, your HOA dues, have to be paid on a regular basis. As long as you keep those things up, there is no issue with the program. Oh, wrong direction. All right. Key protections and safeguards. No mortgage program has more statutory safeguards, disclosures, and transparency than a reverse mortgage. This is a no recourse loan, meaning you and your heirs, your estate, can never be personally liable to repay more than the home's value at sale. Any shortfall is covered by the insurance. So the FHA insurance that is put into place to back this program is what covers any deficiencies. So, for example, if your property initially appraised at $1 million, you end up owing $1.5 million, or the final appraisal is $1 million and you owe $1.5 million, that initial appraisal that was set, you're never going to pay more than that $1 million back. I mean, that's not what you owe. And we're going to talk about that here shortly too. If your heirs decide they want to purchase the property, there is a benefit for them also. The loan never expires, meaning that the note states that the loan won't expire until the 150th birthday of the youngest borrower. So this is protecting the surviving spouse. And once again, as long as the property tax, the insurance, and the homeowners association dues are paid, even if the term of the loan has gone to fruition and there is no more, if you're on a monthly payment plan where it's paying out monthly and that has gone to the maximum number of payments available, it just stops. You can still live in the home um, for basically forever. So until the last surviving borrower passes away, you get to stay in the home forever. So that's a huge benefit. No foreclosure for non-payment. So as long as one borrower occupies the home, pays the taxes and insurance, and maintains the property, no repayment is required. So that's the whole key. You can utilize all of these funds for as long as you want to, stay in the home as long as you want to. It doesn't ever, they can't foreclose on you. You can't be kicked out of your home. So once again, one of the key protections and safeguards. Oh, what is going on here? Let's move this out of the way. Okay. Additional safeguards. You have a cash flow guarantee. So documents ensure your funds can never be disrupted, even if your lender goes out of business. So once again, this is a program that is government backed. It is guaranteed that you get to stay in your home. You're never going to run out of funds. It's never going to have a problem, even if the company that set it up goes out of business. Late fee protection. So if you're a loan servicer, there will be a servicer involved in this generally. Is ever late sending your funds out, they must pay you a 10% late fee. So you get the late fee protection. um, Statutory rate and fee caps, interest rate caps, and origination third party fee caps are mandated by law. So this is all regulated, it's all government sponsored, it's all government backed. So there are extreme, close regulations that have to be followed, and you cannot go outside those guidelines. Prepayment flexibility, partial or full prepayment anytime, no penalties. Payment method can be changed throughout the life of the loan at any time, and that goes both ways. Your line of credit, if you decide to take a line of credit versus a monthly payment or a 10-year program, however you want to look at that, the line of credit increases all the time. Also, every year it goes up by basically almost 6 to 6.5%. So your line of credit, let's say, started at $400,000. The first year that it is open and available, it's going to increase by $24,000. So it goes from 400,000 to 424,000. Goes up another 6% the next year, another 6% the next year. That's why this program is extremely beneficial in financial planning in the long run. If you have a financial advisor that's helping you to plan out you know, your finances, your investments, your everything you're doing later in life, this is also an extremely useful tool to help you plan for your retirement and gain access to more and more of your equity that you've built up in this home that you've lived in for many years, to have available to you. So you can also be paid back at any time. So there are no penalties. So if you hit the lottery and said, well, I don't want to have this open anymore and you just want to pay it off, pay it off. No prepayment penalties. And you also have a 3-day right to cancel. So there's a 3-day right to rescind. So after the closing, you have a 3-day right to cancel with no obligation or expenses. So you get to sit and think about it. If you decide to resend, you can resend them back out at any time. You just have to do it within the 3 days. Generally, that's up to midnight of the third day. All right. So, 6 ways to receive your funds. As I was talking about earlier, we have lots of flexibility on these programs. Now, another thing to realize is that the Hecm government backed program is for people that are 62 plus and older. There are proprietary systems or proprietary programs, I should say, by lenders, by investment groups out there that will go down to age 55, and the restraints are less. They're not government backed. It is called some people refer to it as the jumbo reverse program, because it does go up to 6 million, $4 million, somewhere in that range. So instead of being capped at the $1,200,000 range based on FHA, Fannie Mae, Freddie Mac, the FHA numbers, sorry, not FHA, different than Fannie Mae, Freddie Mac. The FHA guidelines for maximum loan amount across the country, 1.2 million generally is the highest amount you can go up to. The proprietary programs for 55 and older individuals, if you want to start at 55, will go up to much higher values. So you can utilize much more of your equity if your property is valued much, much higher than $1.2 million. So, 6 ways to receive your funds. Flexibility is one of the program's best features. Choose the option that fits your financial needs and change it anytime after closing. One is a single draw, a full lump sum at closing after the 3-day cancellation period. 2 is a line of credit, so draw as you need it. Unused balances grows monthly at the credit line growth rate. So that's what we were talking about earlier. Usually there's about a 6 to a 6.5% growth rate per year on your line of credit. A monthly tenure is a tax-free monthly income for life. As long as one borrower lives in the home, it gives you a monthly payment that is yours to use as you please, and it is tax-free. Monthly term. These are larger monthly payments and set for a number of years. So if you don't want it set up for tenure, meaning as long as you're alive, or as long as you're um, alive, as it says there, lives in the home. Um, income for life and as long as the borrower lives in the home. So my apologies. Um, Monthly term, then you just set the larger payments and set it for a number of years. So say you wanted those payments out over 10 years and you know that's how long you want to take the payments for, you just set it up. Number five, modified 10 years, a smaller monthly income plus a line of credit for an additional draw. So you can be modified and use both aspects of that, the monthly payment and the line of credit. And then a modified term, allocated line of credit combined with a monthly payment of your chosen amount. So those are our 6 ways to receive funds. And this is not the loan of last resort. Financial advisors will be of greater help to their clients if they focus on a broad array of tools. So, including working longer, controlling spending, and taking out a reverse mortgage. So, this is a quote from the Center of Retirement Research, Boston College, April of 2012. The next one is from Reversing the Conventional Wisdom from February of 2012. A quote reads, "We found substantially greater cash flow survival, 90% versus 55%, when the reverse mortgage credit line is used in an active strategy rather than a last resort." So, once again, this is a financial tool to help you in your later years to take advantage of your equity. Think about it, guys. If your home is sitting there and you have $1 million home and you have $600,000 in equity that you can't access, it is doing nothing for you. It is at the mercy of the market. It is at the mercy of, you know, the housing crash of 2008. That was when mortgages went crazy. Um, we saw the opposite happen. That's when, pricing tended to drop, rates went up. The opposite happened in the 2000 during the pandemic. Rates went way, way down and prices went way, way up. So you're at the mercy of the market, meaning that the value of your home can change instantaneously based on things in the world that you have no control over. If you are in a reverse mortgage line of credit, your credit is going to grow by the minimum of 2.5% every year. And generally it averages about 6 to 6.5%. So, and we can talk about the 2.5%, what I'm getting at there. If you schedule a call with me, we'll sit down and we'll go through all of this. So the fiction is only seniors who are house rich and cash poor use reverse mortgages, meaning that it's a loan of last resort. This is not last resort. This is something that should be seriously considered by everybody that has a large amount of equity in their home. Um, the fact is that the proceeds are not taxable and do not affect your Social Security, your Medicare. Estate planners usually reverse mortgages creatively for clients at all levels of net worth. So, no matter what level of net worth you have, this can be beneficial to helping you plan your estate and plan your living for the rest of your life. All right. How can you use your funds? Sorry, let me move that. How can you use your funds? First thing is for quality of life, eliminate mortgage payments. Reverse mortgages have no mortgage payments. You either take a lump sum, use a line of credit, or you take monthly payments. You receive monthly payments. Now, it's the opposite. Instead of making mortgage payments and having your principal go down and your equity grow, you are utilizing that equity. So your principal goes up and your equity shrinks. But once again, line of credit also increases. It's just the total opposite. So you fund in-home health care, so you can eliminate mortgage payments, you can fund your in-home health care, you can stay in your home longer. Protection, save home from foreclosure. This is a way, and there are people that do get into a bind where they can't make their mortgage payment because they're on a set income now. They've retired, they have a set income, your property taxes keep going up, your insurance keeps going up, cost of living keeps increasing, and it's hard to stay ahead of that. So you get yourself into a bind where that mortgage payment on top of all the other bills that you have becomes the issue. How about we reverse that? How about we reverse it where your home takes care of you and pays you to live there? manages longevity risk, and it also protects the estate for the heirs. Literally, it does. And cash flow, pay off high interest debt, cover property tax and repairs, travel. You can travel or provide living legacy and asset allocation. Preserve other portfolio assets, mitigate tax consequences, use home equity strategically. Um, so instead of having to pull funds from your 401k or investments that you have, you can pull funds from your equity in your home. To me, it makes a lot of sense. All right. Let's see if we can move on to the next one. Oh, I keep messing this up by playing with this. Move this out of the way. Okay. The Hecm, what the Hecm? The home equity conversion mortgage for a home purchase. And these can be used to do a home purchase. So let's say you're looking to buy a home and you've saved up or have a ton of cash available and you want to pay cash. Use the Hecm as a purchase tool. The way this works is, so you got $1 million home you want to buy and you were looking to pay cash, $1 million out of pocket. Well, let's only put $500,000 down and keep $500,000 cash for you to be able to invest how you would like to invest it, and have your financial advisor use it to help you make money in a faster way. Have your $500,000 line of credit available that's then going to grow every year by 6%. So on 500,000 becomes 530, becomes 560, just keeps growing. And then you can utilize those funds when you want and need to, and or then invest them. So this is the case study is 78% of households with a member of age 65 plus own their own home. 89% of those seniors want to age in the home they own, meaning they want to stay there. The home equity conversion mortgage purchase program makes this possible. So the case study listed on the left is John and Mary listed their current home for sale and put a contract on the purchase of a new patio home. Short time later, they settled into their new home in the ideal location and with all the amenities they wanted. And as a bonus, they had money in the bank to help meet other expenses. So John, as you can see, is 70, Mary is 68. Net proceeds from the home sale are $160,000. Dream patio home price is $250,000. So with the Hecm purchase, their required down payment, including closing costs, was only $118,000, leaving $42,000 in the bank. No monthly payment ever, as long as one borrower lives in the home and keeps taxes and insurance current, and the homeowners association, obviously. So this example, guys, is that you're not going to be paying a monthly mortgage payment on $250,000 mortgage, or 250 minus 3.5%, 10%, 20%, whatever you decide to put down, plus closing costs. The home equity conversion mortgage, the Hecm purchase, instead of putting all $160,000 down, they can put $118,000, leaving $42,000 out of those proceeds from the sale of their previous home in their bank account to help pay for things. It also then leaves them a line of credit that's available, or monthly payments, however they want to do it. And they're not having to pay a monthly mortgage payment and drive down that principal to gain back their equity in their home. Okay, this is a 6-step process, everybody. First of all, it's education, it's counseling, you apply, you get an appraisal, and you close. Um, from first conversation, from first conversation to closing, Next Lending guides you through every step, ensuring you understand your options and retain all of your rights as a homeowner. And this is my information here, everybody. I am John, and this is me. Oh, there we go. So there's me. Um, these are all my credentials. Got my NMLS number, my email address. These are our company credentials. And like I said, I'm with Next Lending. Oh, that's backwards on the screen, it looks like. Should have switched that around. So, that is what I have for everybody on home equity conversion mortgages. Um, Please reach out, give me a call. As you can see, uh, you can call my office number or call my cell number. I don't mind. Um, Either one will get you to me. One will take you through some other steps to get to me, but eventually, if you just say, I want to talk to John, they'll forward you right to me. So um, please reach out. I'd love to help. I'd love to help people secure, their retirement and make sure that they're going to be safe and secure in their own home for as long as they want to stay. And that's exactly what this program does for you. So everybody have a great day, and I look forward to talking to you all. Thank you.